Welcome to today's Explainer. We're putting an absolute titan of the financial sector through the ultimate investment stress test. Today's contestant in our valuation gauntlet is none other than American Express. We're going to look way beyond the prestigious brand and those shiny platinum cards to find out if the underlying numbers actually justify a spot in your portfolio right now. To do this, we're putting on our expert investment analysis hats, applying the legendary time-tested frameworks of some of history's greatest investors to see exactly how this stock holds up under pressure. All right, let's look at the roadmap for today. We'll kick things off with a company snapshot, look through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, run a DCF valuation, and finally wrap it all up with our synthesis and verdict. Let's get into it. Section 1, Company Snapshot, American Express. So, looking at the current state of play from their Q1 2026 release, American Express is honestly operating from a massive position of strength. The stock is sitting right around $329, commanding a hefty $224 billion market cap. But here's the kicker, and why you should really care. First quarter revenues jumped 11% year over year, hitting $18.9 billion. This isn't just your grandparents' legacy credit card company anymore. It's a massive global payments ecosystem, and it is actively accelerating its top-line growth. Moving right along, Section 2, the Buffett lens, moats and management. Now, you probably know that when Warren Buffett looks at a company, he absolutely demands a wide economic moat. And the reason he's historically loved American Express? It all comes down to their closed-loop network. Think about it. Unlike Visa or MasterCard, which are open-loop and rely on third-party banks, Amex is the whole package. They act as the card issuer, the payment network, and the merchant acquirer, all at once. Because they control this entire loop, they capture the full economic value of every single swipe. Combine that with a famously affluent customer base that just keeps spending even when the economy gets rough, and you've got some serious Buffett-approved pricing power. And the numbers here are just wild. American Express generated a staggering 35.2% return on average equity in the first quarter. Plus, they produce over $12.1 billion in annual free cash flow. We can actually use that cash flow as a really solid proxy for Buffett's owner earnings. The capital efficiency here is just top tier. Now, sure, their debt to equity is naturally higher at 1.73, but that's just the mechanics of their lending portfolio. Their massive liquidity and $6.5 billion in quarterly interest income easily covers those obligations. So under the Buffett lens, focusing on those qualitative moats and premium returns, ASXP is a screaming buy. All right, Section 3, the Lynch lens, categorization and growth. So Peter Lynch loves to categorize companies so he can really nail down their specific growth trajectory. Take a look at this data. Amex's U.S. consumer build business growth has impressively accelerated from 6% a year ago all the way up to 10% today. Given its massive size and reliable compounding, Lynch would probably peg American Express as a stalwart that's actively flirting with fast grower status. It's basically a giant defensive ship that's somehow still picking up speed. But if you know Lynch, you know his golden rule. You always evaluate a stock's price relative to its growth. To find his famous PEG ratio, we just take AXP's current trailing PE of 21.1 and divide it by that really impressive Q1 year-over-year EPS growth of 18%. Run that math, and we get a PEG ratio of 1.17. For Lynch, a PEG of exactly 1.0 is fair value. So at 1.17, yeah, you're paying a slight premium, but it's honestly far from dangerous territory. Just to be completely transparent here, and to make sure we're being thorough in our analysis, Lynch also loves seeing heavy insider buying and low institutional ownership. We actually don't have the current quarter's insider trading data in our snapshot, so we're just going to neutrally assign AXP a hold on that specific sub-criterion. But zoom out, and combining that PEG ratio with the stalwart growth profile, the whole Lynch framework points to a very solid hold. Next up, Section 4, the Graham lens, the defensive investor. Okay, so American Express has charmed Buffett and totally satisfied Lynch, but can it survive Benjamin Graham's notoriously strict, cold-blooded defensive investor gauntlet? You know Graham. He requires a massive margin of safety and insists on running stocks through a rigorous checklist. Amex effortlessly passes his requirements for adequate size, strong financials, and consistent earning stability. It also breezes through the dividend record test. But here is where the fortress crumbles. Graham demands a moderate valuation, strictly preferring a PE ratio under 15. At 21.1, American Express fails this valuation test outright. To see exactly how far apart the current market and Benjamin Graham really are, let's run his famous intrinsic value formula. That's the square root of 22.5 multiplied by the trailing EPS multiplied by the book value per share. Punch in those numbers, and it spits out a Graham fair value of exactly $133.19. With the stock currently trading all the way up near $329, it completely lacks his required margin of safety. Without even blinking, Graham would unequivocally rate this stock a sell. Moving into the modern era, Section 5, Discounted Cash Flow Valuation, or DCF. All right, shifting gears from historical guru philosophies over to modern Wall Street math, let's build a discounted cash flow model. Because we always want to show our work and truly stress test this asset, here are our explicit base case assumptions. We're starting with their $12.13 billion in annual free cash flow, forecasting that out 10 years at a 10% growth rate, which neatly matches their Q1 build business growth. We're using a perpetual terminal growth rate of 2.5% to basically mirror long-term GDP, and then discounting all of that back using a 9% industry-averaged weighted average cost of capital. When we run those variables through our sensitivity matrix, our base case scenario, which is the intersection of that 9% discount rate and the 2.5% terminal rate, outputs a fair value of approximately $310 per share. Given the current trading price of around $329, the quantitative math tells us the stock is fully priced right now, if not slightly overvalued. It offers no distinct margin of safety, making it a quantitative hold. Finally, Section 6, Alternative Models and Synthesis, Final Verdict. Before we hand down our final verdict, let's run two alternative quantitative models just to make sure we aren't missing any hidden angles here. First, applying a dividend discount model, which values a stock based purely on its future dividend payments and aggressive share buybacks, we get a surprisingly rosy fair value of $380. On the flip side, if we use a simple comparable forward PE approach, we land at a fair value of about $320, which is actually strikingly close to our DCF output. Synthesizing all this data reveals this really beautiful tension in American Express stock today. On the qualitative side, it's a high-quality fortress. It's got unmatched pricing power and an elite ROE that Buffett just loves, which triggers a clear buy. But over on the quantitative side, traditional math suggests it's basically priced for perfection. Lynch says hold, our DCF says hold, and Graham is basically screaming sell because that margin of safety is just non-existent at this price level. Ultimately, the data tells a really clear story. American Express is a spectacular business, but you are absolutely paying a premium price for it. If your investment philosophy aligns with Warren Buffett, where you prioritize a wide moat and you're willing to pay up for a magnificent compounding machine, AXP is a really strong candidate for your portfolio right now. But if you're a strict value investor holding out for Benjamin Graham's required margin of safety, honestly, you might be waiting forever. The numbers have spoken, so I'm going to leave you with this final thought. Based on the gauntlet we just ran, what kind of investor are you?